Hello there. Welcome back to Grade 10 Accounting. In this video, we want to look at the aspect of Term 1, that is the GAAP. This is the generally accepted accounting practice. So we are going to look at various principles that fall under the GAAP. We are going to start by trying to describe exactly what we mean by GAAP. So you will see that GAAP is a set of accounting rules, standards, and also procedures. Obviously, this is what describes GAAP. So these principles ensure consistency, accuracy, and transparency in financial reporting across various industries. So you're going to see that the preparation of financial statement is also going to be based on these principles. So the goal of GAAP is to ensure that the company's financial statements are complete, consistent, and comparable. So this is what we have. So uh, they allow investors to analyze and extract useful information from financial statements, therefore enhancing comparison of financial information across different companies. So you're saying every company has to apply these principles, and it becomes easier for the investors to compare between different investment destinations so that it becomes fair to investors. So basically, GAAP comes as a protection on the investors' decisions on whether to invest in different options in terms of businesses, are investing in business A or B, since the financial statements in those businesses are being prepared on the same basis. So basically, that's what we have. So going to our information that we have according to this video, we are going to say that we are also having the description that we have at the beginning of GAAP, which means generally accepted accounting practices. So a GAAP is a set of accounting rules used in their financial disclosures. In the Republic of South Africa, that is RSA, the Accounting Standards Board plays an important role in the development of these standards for certain events. For example, we are given presenting text in the financial statements. So the objective is to limit the variety of available accounting practices without striving towards strict uniformity or a set of rigid rules. The objective of accounting standards in financial statements is to eliminate unacceptable alternatives. So basically, this is what we have in terms of explanation of our GAAP. So we are going to see that we've got various examples of GAAP principles that we have, whereby we've got the historical costs principle, we've got the prudence principle, we also have the materiality principle, business entity principle, going concern principle, and lastly, we've got the matching principle. So this is what we have on the various elements of our GA. So we are going to start on the historical cost principle. So the historical cost principle basically is the principle, it's a principle, or we can call it a strategy used in accounting that values assets at their original costs. So assets are valued at the original cost, and we call it a historical cost principle. So explanation that we have is that the concept is the concept historical cost means that assets purchased by a business must be recorded in the books at cost price. That is the purchased price. So very important for you to take note. So I give an example on the application of historical cost principle, whereby it reads, if you bought land and buildings 3 years ago, it takes rands and entered it into the books at that price, and the asset is revalued today, in the statement will still be 500,000, which is the price that was originally bought, was used to originally bought it. So basically, we say that the value that is entered in the books of an asset is the value of the cost price. So here we give an example whereby you got the cost price of 500,000. Then after 2 years, that as the amount that is considered for recording in the books of accounts is 500,000, which is the cost price. So that's what we have in terms of the essence of historical cost principle, whereby we're saying assets will be recorded at cost price. So basically, that's what we have. Then next, we've got the prudence principle that we want to look at. And explanation that we have in terms of prudence principle is that it says that income and assets, income and revenue are not overstated in financial statements. Alternatively, this prudence principle is known as the conservatism principle. It also makes sure that liabilities are not understated and provisions are made for income and losses. So basically, that is also the explanation that we can give in terms of the prudence principle. But we have an explanation that we have according to this video concerning the prudence principle. So we have an explanation which reads, and this is also known as the principle of conservatism. When the accountant is uncertain about the values of an element or event, that is assets or liabilities or income or expenses, the prudence principle must be applied. This means that the accountant who prepares the financial statements should be conservative in their approach to these uncertainties. So conservatism, it means we don't have to overstate our profits, our revenue that we have in the business. So that's the basic essence behind conservatism. So the value that is the least influence on the equity of the business must be used. So that is what we have done. Example of prudence principle is that if a debtor is in financial difficulty, the accountant may write the account off even though the business will continue to do everything possible to receive the money the debtor owes them. So this is an example of a bad debt whereby we are saying we sold goods on credit, but there are signs that that debtor might not pay the amount that he or she is owing. So we are supposed to write it off as a bad debt in the books, although we are going to make some effort to make sure that we receive that money. That is what this example is trying to illustrate. Then you go to the next one, which is materiality principle. And it reads, the materiality principle demands that all important in brackets large transactions and events should be indicated separately in the financial statements as these may influence decision making. Unimportant amounts need to be indicated separately, but should be added to other amounts of similar nature or functions. Here is also another part that is important. The accountant will be conscious of whether an adjustment entry will be important in brackets material to the financial results of a business. An adjusting entry might be omitted if the amount is regarded as insignificant. So the trade principle is based on the essence of the significance of the transaction that we record in the financial statements and the classification that we should do in terms of the transactions that we engage in the financial statement. So this is what we have in terms of materiality principle. So moving on, you would see that we now have what we call the business entity rule. The business entity rule. So business entity rule basically it separates the transactions that take place of the owner of the business and the business. So it separates the two, and that is the transaction of the owner and transaction of the business. They are separated and should be treated differently. So it means that the objectives of accounting is to present information about the financial situation of a specific business or individual. Such a business or individual is known as an entity. The concept entity refers to a unit that exists independently and can be clearly defined. The financial affairs of a business must be kept separately. That's where we have the basic concept. The financial affairs of the business must be kept separately from the financial affairs of the owner. The business statements of the business, no transaction of the personal affairs of the owner will be shown. So transactions of the personal affairs of the owner should not be shown in the books of account. That's why we adjust for drawings, and also we have the aspect or the concept of capital. So that explains the business entity rule. The example that we're given is that if the owner inherited 500,000 rands from his or her father, the money will be deposited in the owner's personal bank account and not in the business bank account. So we are trying to separate a transaction of the private transactions of the owner and transactions of the business. So next we have got the going concern principle. And the going concern principle says that it assumes that any organization will continue to operate its business for the foreseeable future. The entity is viewed as continuing in business. So that's the going concern principle. So it doesn't, basically we are saying the going concern principle, we are saying it assumes the business is going to be operating in the foreseeable future, although there are indications that the business is going to maybe stop operating in the near future. The assumption is made that the business will continue to operate for the foreseeable future. So the explanation that we have is that the concept going concern means that an entity or business will continue to exist for a certain period, and that the financial statements of a business are prepared as though the business will continue to exist for some time. So I give an example again. Stock, fixed deposit, and land and buildings are not valued on the basis of the amount that would be received from them if they were sold immediately. So this is what we have. So we are saying valuation of that current assets in the form of maybe land and buildings, fixed deposit, we are saying it's not based on the and net realized of value, that is the amount that you expect to receive if you sell the that current asset today. But we record that we record them at cost price. So basically, that's what we have. Then matching principle is the next one. So matching principle says that it is also an accounting principle that detects that companies report expenses at the same time as the revenue they are related to in the same financial period. So that's what we have. So it basically says that the revenue and income, or the income and expenses that belong to the current period should be recorded in the current period, and the income or expenses that doesn't belong to the current period should be removed from the current period. So basically, that's where the aspect of matching is coming in. So beneath that, we have got an explanation which is all transactions or events that take place during a certain financial period must be recorded in the books during that financial period, irrespectively of when the cash is received or paid. Income and expenses incurred in order to receive such income need to be brought into account during the same period. This implies that expenses incurred in order to create income must be matched to that income during this present financial period. So basically, that's the explanation. And on the example, if a building is rent from somebody, uh, is a building is rented from somebody, and we only paid 50,000 rands, that is 5,000 per month for 11 months. The 5,000, so it means that if you paid 11 months, which means the member of financial period is got 12 months. So if it's for 11 months, it means there's one extra month that was not paid. So the 5,000 rands would be matched with the 55,000 rands, because it is part of this financial year. So it should be recorded. Although we paid 11, the extra months should be included in the recent financial period, because it belongs to this period. So that's the essence of what belongs to the current period should be recorded in the current period. So next sentence, the amount recorded in the financial statements will be 60,000. So basically, that's what we have. So that's the explanation that we have in terms of matching a principle. And this is the last part of our principles that we have. And finally, we have got an activity that we have there in terms of identifying the principle according to given explanation. So we can go one by one to try to match to the principles that we are given there. So it reads, I choose a word or term from column B that best suits the definition in column A. A word or term may be chosen more than once. So very important to take note. So you're given column A, you are given column B. So column A is all transactions or events that take place during a certain financial period must be recorded in the books during that financial period, irrespectively of when the cash is received or paid. So we have explained this under the matching principle. Remember, this clearly says the matching principle. So we are saying matching principle, we are having matching principle in column B at D. So we are saying on the first part, we are going to indicate our D. So we can just say first part with the D. The second part says that is we are now on two. An entity that is business will continue to exist for a certain the business will continue to exist for some time. So we have explained again in the concern we have it at A. So we're saying A. When you go to A3, assets purchased by a business must be recorded in the books at historical cost. So we have B. Go to 4, the accountant preparing financial statements to be conservative in their approach to uncertainties by using value that is the least influence on the equity of the business. We've explained it to be prudence principle, and we have it on E. And then we try to go to the next one, which is now 5, which says the financial affairs of business must be kept separately from the financial affairs of the business. We have identified this as the business entity principle, and we are using business entity rule C. So we have C as the correct response. Number 6, all imported or large transaction events should be indicated separately. We have identified this as material principle of materiality, which is F. So we can just indicate our F. At 7, bad debts to off is an example of this principle. We have explained about bad debts when we are explaining about the prudence. We put prudence at E. So we can just indicate E, number 7. Number 8, interest expense is to appear separate to a bank overdraft account in the financial statement. This is separation of transaction. We are saying this is the materiality principle, materiality F. Remember, at the beginning of the question, they gave an instruction that a word or a term may be chosen more than once. So we have chosen the principle of materiality F on number 6 and it's appearing again on number 8. So we're having 8. And this is again historical cost, which is B. So we can indicate that as B. When you go to 10, the owner of the business cannot list his Mercedes for personal use as a business asset. Again, this is the business entity rule. We are having it LC. So this marks the end of the information that we have according to this video. So thank you for listening. And please, let's not forget to subscribe to our channel. Let's not forget to subscribe and share. Let's share the link to our colleagues who are doing the chain accounting. And remember, more videos are going to come. So let's stay tuned. Let's get notified. Let's subscribe. Let's turn on the notification button so that when we upload the new videos, you get notified. I'm signing out. We'll meet again in the next video.